Hi, Hutch here again with redirectmytaxes.com. Welcome back to the course. And if you've gone this far, you probably already have taken away some ideas where you know you'll be saving some tax dollars a day. And what we're going to spend the bulk of our time on in this video is looking at the threat of future higher taxes and seeing how you can deploy some of the savings from the strategies implemented today to plant some seeds to harvest some tax-free income for the future. I want to first begin by looking at the possibility of you retiring in a lower tax bracket and why that's complete hogwash. So I'm sorry to use such harsh diction, but this is an assumption that's held true by a lot of planners and the media, almost like retiree has its own set of tax brackets, and they don't. So it assumes that you're going to be living off of less money than you're living off of now. And I don't know about you, but I don't really want to do that. Here's some other factors that are going to make this very difficult to achieve. So your kids are probably going to be grown up and are no longer going to be able to be claimed on your tax returns as exemptions. So these savings are going away. Your mortgage may be paid off or maybe getting close. And the deeper that you get into a mortgage, the less of those payments are interest and therefore deductible. Also, similarly, the rental property you have may be fully depreciated or getting close. And last, probably your business is gone at this point. You've sold it or passed it on. And with that business comes a number of deductions that we've already talked about. And I know a lot of my clients run a lot of their personal expenses through the business. Well, that's gone. And now everything's fully taxable. So I think it's important that you realize that regardless of what the federal government does with raising taxes, even if all the brackets stay exactly the same, and even if you're living on the same amount of money, chances are you might be at a higher tax bracket, or even if you're living off of a little bit less money, you're going to lose deductions and it's going to make it really difficult to retire in a lower bracket. Now that you know the internal factors that are going to keep you from retiring in a lower tax bracket, let's take a look at the external factors, what I call the stroke of a pen effect. And that would be Congress's ability to raise or lower taxes as they see fit. And a lot of my clients are already in the top tax bracket. Either that or, like I said, they're Henrys, high earners, not rich yet, in which case their own success is catapulting them to that level. So with that, let's take a look at the history of the top marginal tax brackets since the inception of the income tax. So a lot of people don't know this, but in 1913, the United States federal income tax started as a temporary tax. With World War I impending, it actually started at a very low rate because remember, our country was founded basically as a revolt to high taxes. And this 7% rate quickly accelerated to 73 as our involvement with the war grew. Now, that war subsided, and during the roaring 20s, the economy was good, and so they lowered the tax brackets back down, but instead of going back to the 7, we went back to 24. And at the end of the 20s, with the Great Depression and the stock market crash, they quickly accelerated back up to the 73% level for the top income earners. And during the 1930s, as the Great Depression ensued, they got as high as 79%, and as the economy improved, came back down to that 25% level. So lo and behold, another war is on the horizon, and we quickly needed to raise taxes back up to the 80 and at times 90% level. And it actually stayed that way throughout the next decade. And this is where I was talking about that Elvis would only make one hit movie or one hit record because quite frankly, it didn't make any sense because all his production was going towards involuntary philanthropy. And they came back down during the Vietnam War, but back down to the 70% level to again where they stayed in that 70% level throughout this entire decade of the 70s. Now, once Ronald Reagan got elected, he implemented the closest thing we've ever had to a flat tax where there was just 2 tax brackets, and the 70 went down to the top tax bracket of 28%. And it was at a very low threshold, so pretty much most of any high earner's income was going to be taxed at that level. And the people in the lowest brackets was 25. So there were really just 2 tax brackets there. And then you can see in the next decade, as the presidential regime changed, it went back all the way up to 39.6. And then again in the 2000s with the lost decade, they went down to as low as 35%. Granted, this is the highest tax brackets. And now just recently, after the fiscal cliff, we're back up to 39.6. So there's a couple things I want you to take away from all this. One being, right now you think your taxes are really high if you're in the top tax bracket. I want you to take a look at these numbers and see what's possible. I also want you to take a look at how volatile the changes are and what little really needs to be done in order for them to accelerate. So again, what we're going to focus on for the rest of the video is a solution to this problem and a way for you to potentially buffer against future higher tax brackets. Can you even retire in a lower tax bracket in retirement? Probably not. But if you can, it's going to be because of one of two things. One is live on less income. And that would be significantly less income if you're already in the highest tax bracket or close to it. The other is plant seeds now to be able to harvest tax-exempt income later. So I find my clients spend a lot of time diversifying their portfolio by asset class or by risk factors, but their advisors often aren't able to advise on diversifying by tax status. And what I mean by that is this. If I looked at your portfolio, probably everything you have is either taxable, meaning each and every year that you recognize gains or income, you pay tax on that, or it's tax deferred. It's in some sort of qualified plan where it's growing tax deferred, but as soon as you take out a distribution, that will be taxed at ordinary income rates. Or you have real estate where, again, it's growing tax deferred, but as soon as you sell a property or you take any rental income, that also is taxed at ordinary rates. But if you were to have a tax-exempt bucket of funds that will allow you to choose each and every year how much is taxable, that would give you a lot of flexibility to be able to control your tax bracket to a degree in retirement. So you could toggle each and every year how much taxable income you take versus how much tax-exempt distributions you take. And if we think about the volatility of how those tax brackets change, this is going to be huge because they're not going to stay at one place and be static. Each and every year, you're going to need to work with your advisors and figure out the most tax-efficient way to support your lifestyle.
All right, so I personally am a visual learner, and I find that my clients have a lot easier time digesting concepts when they can see them visually. So we're going to see exactly what I mean by utilizing some of these tax-saving strategies during your working years and how to plant the seeds now so that you actually can toggle your tax bracket during retirement. And we're going to take a look at the 2015 brackets to do so and understand how a progressive tax system works. So what that means is essentially the more you make, the higher your tax bracket gets for those specific income levels. So when we saw the history of the tax brackets, we were always looking at the highest tax bracket, but not all your income is going to get taxed at that highest bracket, even if you make that much. So for example, the first $18,000 you make will get taxed at the 10% bracket, 18 to 74 at 15%, 74 to 151 at 25%, 151 to 230 at 28%, and so on. And these last final brackets are really the costliest from a tax standpoint. So what that means is the last dollars you earn, the more successful you are, the bigger chunk of tax they're going to take out from those dollars. And also keep in mind, if your state charges income tax as well, whatever that tax rate is, you can just add that to the percentage on the left. So even if we have a very successful married couple, say making over $500,000 per year, it's really going to behoove them to use the strategies discussed in the previous videos to manage their tax brackets so that they remain in these lower tax brackets, at least from a reportable income standpoint. And the obvious reason is they avoid the higher brackets in the 30% range. But the other less obvious reason is the federal government actually starts to phase out how much you can use of your personal exemption and itemized deductions as you start to get deeper into this next bracket. So even if our couple does have a very robust income from these various sources, and assuming that they actually could live off of 230 of taxable income to support their lifestyle, then they could employ some of the strategies discussed in the previous videos to make sure as these higher cash flow numbers come in, they're avoiding getting hit by these highest and most deadly brackets. So now let's take our same successful married couple and put them into a retirement scenario. The same problem still exists. The more they make, the more taxes they're going to have to pay. So for simplicity's sake, we're just going to use an example in today's dollars. And we find that for our most successful clients who have done such a good job accumulating wealth in their working years, it's going to be a lot more difficult for them to try and compress the reportable taxable income to these lower tax brackets in retirement. If they were a business owner, the business is gone, and therefore so are most of the deductions. Mortgages are probably paid off, depreciation exhausted, kids grown up. And although there may be some advanced charitable strategies still in play for them, we find that if they had the wherewithal to plant seeds to create this, what we call tax allocation effect, and have some additional assets in their portfolio that did produce tax exempt retirement income, they could go ahead and enjoy these larger cash flow numbers without getting penalized and taxed at these higher brackets. Now, remember, we're looking at avoiding the highest brackets in today's tax rates. Nobody knows what they're going to be in the future. And if you remember from the past, how quickly they changed, how volatile they were, and how high they got with the stroke of a pen. Nobody knows what they're going to be in the future. But if this ability, this way to buffer your tax bracket and choose how much income you take from the highest brackets is important now, well, just imagine if they do change with the stroke of a pen, how important this factor is going to be in your retirement planning model. So now we're going to take a deeper dive into those three asset classes down on the bottom right in green and see why one stands out far above the others when it comes to comprehensive tax planning for the different stages in your life.
So why not municipal bonds? Or I should say, why not municipal bonds today? Because this was really the tax-free asset class of choice in the past, and rightfully so, because interest rates were much higher in the past. So you could buy these bonds and lock in a relatively high interest rate. But quite frankly, today, there's just not enough reward in them in our low-yielding interest rate environment. And it's not just that, but there is actually a risk of principal. And although you can protect against the creditworthiness of the issuer by buying insurance on these bonds, that will further reduce your interest rate risk. And we've already seen several municipalities default already, and you can buy, I guess, riskier municipalities and get a higher interest rate risk, but you are subjecting your principal to risk. The other way that your principal is subject to risk is interest rate risk. So in an environment where you locked in a high yielding bond and interest rates were falling, the value of that bond that you bought goes up because you can't get as high of yielding bonds. But most people will agree that we're probably at or near the low end of the interest rate cycle, and they have to go up. So what's going to happen to your principal in these bonds is as interest rates go up and somebody could go to the free market and purchase new municipal bonds at higher interest rate, the value of your bond that you bought down here will go down. And so your access to your principal, if you need to use this money or borrow against this money, is subject to the market value at that time. And if for whatever reason the value went up because interest rates even went further down, those are subject to capital gains, contrary to popular belief. Let's talk about the Roth IRA option. We love Roth IRAs. They can be great. However, there's some severe limitations to be able to get them, especially for the affluent and wealthy. First of all, in order to put money into a Roth IRA, you need to have income. And even then, you're only allowed to put $5,500 or $6,500 a year if you're over age 50. And you can't even do that if you make over about $190,000 per year of married filing jointly income. You can actually do a Roth 401k if that's an option in your 401k plan, and that's an option that we set up. But again, there would be no tax deduction for the money going in, but at least the money coming out the other side and all its growth would be tax-free in the future. But we're talking about $18,000 maximums into a Roth 401k, 24 if you're over age 50. So we're not talking about a huge pool of money, not very high contribution limits. So you can do something called the Roth IRA conversion, and there is no cap on income. Anybody can do this, but as soon as you do it, you create taxable income now today. And if you're watching this course, this is probably something you've been trying to avoid all along. Also with Roth IRAs, there would be market risk during retirement, and that's okay. I think in the long term that markets will succeed, markets will thrive. But if we look at all of our clients' holdings, most of their portfolio is already subject to the same market risk. And last, there's no access for 5 years or age 59, whichever is greater, as soon as you put money into a Roth IRA. Once our clients are informed about the limitations of the other tax-exempt options, a lot of them prefer to substitute life insurance instead. And here's some of the main reasons why. Number one, the contribution limits are based on the client's health and either their income level or net worth. So unlike a very small arbitrary number for, say, the Roth, where you could do $6,500 in a Roth IRA or $18,000 in a Roth 401k, or you can't do anything at all because you make too much money. With this, how much they can put in is really based on how big their income or net worth is. So a lot of times you can do 5, 6, sometimes even 7 figures each and every year if they want to. And the companies that we recommend are all top-rated issuers. So they have some of the highest ratings, not only of life insurance companies, but of all insurance companies in general. And all of them have over 100-year histories where they've been able to weather recessions, depressions, world wars, hyperinflation. And not only have they survived, but these companies, since they're so conservative, have really thrived during these times. And this is very important. Your equity in your policy is accessible and, more importantly, not subject to market risk. So there's a lot of different policy types that are available, but we find that our clients gravitate to the ones where there are contractual measures to protect the principal of their policy and make sure that it's not subject to market risk whatsoever. And even though you have this safeguard or guardrails, as I say, there still can be competitive return options. So again, there's choices with these types of products. This is not your grandmother's life insurance per se. So you can have one that has a slow and steady return similar to what you might find in muni bonds, only no muni bond that I know will double, triple, tentuple your bond if you were to pass away prematurely, which, as you've seen, can tie into other planning. Or if you don't want to go get a safe and steady return each and every year, you can opt to participate in the major market indices, but again, with some guardrails. So you can have it to where even in bad years, none of your policy value is eroded to market risk, but you can participate all the way up to double-digit returns in really good years. Now, there are caps. So if the S&P does 30%, you won't get 30%, but your policy value might get credited, like I said, somewhere in the low double digits.
So first off, let's take a look at Bank of America's balance sheet. And a balance sheet, by definition, is an inventory of assets and liabilities. And all the big numbers over here on the right are even bigger numbers than they appear because they're representing dollar figures in thousands. If we scroll all the way down to line 41, what's interesting is how life insurance is titled on this balance sheet. They call it an asset. And if we look closer, we can see how much cash is parked in permanent life insurance policies. And even though it looks like 19 million, remember that it's actually times 1,000. So this is $19 billion. Now, this number isn't how much death benefit protection they have on the lives of their key executives. That would be an even bigger number. What this $19 billion actually represents is how much cash value or equity the bank presently has in the policies, even though none of the executives are dead yet. Let's take a look at another asset class that most people are familiar with, real estate. So if we look right here on lines 10 and 11, bank premises and fixed asset, other real estate owned, we can see that Bank of America has a little over $12.5 billion invested in real estate. Now, I'm not saying that you should be more heavily invested in life insurance than in real estate, but it is worth exploring why they would do this and how it could possibly benefit your situation. Now, going back to FDIC.gov, let's look at Wells Fargo's balance sheet just to show you that Bank of America is not the only one. And if we scroll down here to total real estate, we can see they have over $10 billion in total real estate. And scrolling down to life insurance assets, we can see they have over $17 billion in total life insurance assets.
That information on the banks and their holdings of their Tier 1 capital, I think, speaks volume to the validity of life insurance as a conservative holding tank. And what I love to say is, don't do what banks say. We'll accept your deposits and pay you a very paltry return and lend money back to you at a much higher interest rate. Just do what they do. Park conservative reserves into investment-grade life insurance. Get better growth opportunities. get tax-deferred growth and tax-exempt distributions. And this is huge for what we're talking about as far as being able to buffer your tax bracket each and every year in retirement, not knowing what those tax brackets are going to be. And last, as a backstop, have some key person protection in the case of premature death. So at this point, once we start talking about life insurance, my clients often tend to start to disqualify themselves, and I would caution you not to. And the reason why is this. Mortality rates across the board are as low as they've ever been. So actually, late last decade, the industry came in and said, you know, you were using the 1980 census tables, which are outdated, and we found that people are living longer, and they forced the entire industry to adopt the new census tables where they realized that people were living much longer due to the advances in medical science. And because of that, underwriting is more liberal with controlled health issues than it's ever been. So things like controlled cholesterol, hypertension, not a big deal whatsoever. We actually happen to be, as independents, some of the best shoppers in the industry. So we're not aligned to any particular carrier. And certain companies are a little more forgiving, say, with certain issues than others. And we're quite knowledgeable about how that works. And when we do shop somebody's health situation, we do it anonymously. We don't say Joe Smith has X. We say, I got a guy. Here's the situation, and we get some indication about where they're going to come in ahead of time. And we've done miracles with things, people just say a few years removed from things like prostate cancer, skin cancer, things that would be serious issues and lead to an immediate decline in the past. We can often get standard or at even times preferred ratings for these issues. And last, only one spouse needs to be insurable. So as I discussed in the last video, you can get these joint policies where the policy only pays a death claim after both spouses pass away. So as long as one spouse is insurable, we can get some sort of insurance. And remember that the policies that we're designing for this purpose often aren't death benefit driven. So the costs are made up largely of how much death benefit you're buying, not so much how much money you're trying to put in. So what we're trying to do is really compress and say, put as little death benefit as possible around the cash here to produce the most accumulation value. And in this case, all these things that you may tend to disqualify yourself won't have as big of an impact. Although we're talking about life insurance in the context of creating a bucket of tax-exempt future retirement income now, let's revisit how it supports some of the other strategies from the previous videos that we looked at. First and foremost, it replaces your income to your family or the value you have to the business and your partners if you were to pass away. And that's just common knowledge. That's what most people think of life insurance and what it's for. But also, it does make your heirs whole for any donated assets. So again, if we're going to employ any of the charitable strategies discussed in the last video, putting life insurance inside a wealth replacement trust ensures that you won't disinherit heirs. And last, it can be a better bank while you're alive just to park liquid assets. So a lot of my clients do have sufficient liquidity inside things like CDs, checking accounts, savings accounts, money markets, and the rate of return on these vehicles always starts with a dot, and it may just be zero, but if it is some sort of positive number, it's very rarely a whole number. It's point something. And this gives you an opportunity for better returns. And even in those other vehicles, if you did earn 0.2 or 0.5, if you have sufficient assets in there, you're probably going to pay some tax at the end of the year just to add insult to injury. Whereas because life insurance provides a social good in the eyes of the government, any growth you receive inside of the policy is tax deferred.
Now that you understand some of the lesser known features and benefits of this type of properly designed permanent life insurance product, let's look at it specifically through the lens of tax planning. And we're going to use an example using the same brackets we looked at, same married couple. They're going to try and compress their reportable taxable income to a level that they can live off of and they can manage. And using some of the other strategies mentioned previously in the course, they'll still have cash flow that gets them up to those higher levels, but avoid the tax in those higher brackets. And they can use this tax savings to start to acquire this type of permanent life insurance so that they can more efficiently distribute their wealth in retirement. I think that another advantage that is worth mentioning that life insurance has over Roth accounts during your working years is the liquidity use and control. So unlike a Roth account where you can't touch it before age 59 and a half, with life insurance, you actually can. And a lot of people think, well, if I put money in life insurance, I can't do X, with X being, say, expanding your business or investing in real estate or any other wealth building opportunity that comes your way. And that's not true, actually. So you do have access to your equity, and there is no age 59 and a half limitation. So you can go ahead and use the equity inside your policy to parlay your wealth building opportunities during your working years. And you can do so in a way that doesn't kill the goose that will someday lay the golden eggs of tax-exempt retirement income. Once they hit retirement, now the fruits of their labor are going to come back and bite them to a degree. So already, Social Security is mostly taxable for anybody who's remotely successful. Rents will be kicking off of rental properties. Retirement plans, you'll be forced to take required minimum distributions. All your brokerage accounts, checking accounts, CDs will all be taxable regardless of the rate. And even if you did set up some charitable split interest programs, all the distributions are taxable. You just get to choose how they're taxed by what assets you put in there. And again, there is no special tax bracket for retirees. So as this income gets distributed to you from these various taxable sources, it is going to push you into a higher and higher bracket, along with whatever tax rate that comes with at that time in the future. And nobody knows exactly what that will be, but I think we can all agree upon the fact that our government spending has increased exponentially. And even if future politicians do indeed curtail the spending, a lot of the damage has already been done. So there's programs, there's liabilities, there's obligations that need to be funded, and that's going to come from our tax dollars. So the more affluent and successful you are, the more wealth you've accumulated inside vehicles that are going to get taxed in the future, the more concerned you need to be about this phenomenon. Having the mechanism to be able to cut off your income at the pass is going to be absolutely critical, regardless of the vehicle you choose. So I strongly suggest you start to think about using some of your tax savings today to plant the seed so that you actually have the tax-exempt dollars inside your retirement planning model.
So if you've gotten this far into the video course, obviously you see the relevance in your life, and maybe one of the strategies or a combination of strategies you know you want to explore further. So let me talk to you a little bit about our process and how this could work going forward. Step one is simple. Click below and schedule your complimentary, no obligation phone call. The link below links automatically to my calendar, so there's no need to play phone tag with any of my staff. Simply find a time that works for you, put the information to call you back on, and we'll have a discussion. Step two, we're going to take this time to answer whatever questions you have from this course. Step three, we're going to explain in greater detail our process for helping you walk through this if we decide to work together. And step four, review whatever you've done with the homework pieces, and if you haven't done them, that's okay. We'll help you get through them on the phone. Step five is identify any potential problems or challenges you may have to implement whatever strategies you're interested in or whatever's most suitable. Step six, determine if we're a good fit to work together. And step seven, if there is a good fit, we'll help you develop an action plan going forward. And if not, that's okay too. We'll part as friends and maybe give you some good advice on your way out. Let me just take a moment to put your mind at ease about what won't be happening during this initial phone conversation. Number one, you won't be charged anything for this meeting. What we're trying to do is just have an initial conversation to see if we're going to be a good fit going forward and to give us a chance to eyeball your fact pattern and start to point you in the right direction as to which strategies are going to make the most impact for your particular situation. You won't be allowed to buy anything in this meeting. So although we can often gauge which direction you should be heading in, you won't be asked to commit any amount of money to any particular program during this meeting. And I can't stress that enough. What we're trying to do is build long-term relationships with affluent, sophisticated clients. As always, don't forget to post your comments and questions. And if you saw value in these videos, I can't urge you enough. Take a look at your calendar right now. Click below, take a look at my calendar. Let's find a time to chat for 30 minutes and see if we can help you redirect 6 to 7 figures of lost tax dollars this year and maybe even the years going forward. I hope to talk to you soon.